Good morning, John, and good morning to all the participants. I have to confess, I tested with Leandri this just before the session that my screen can be shared, so I'm hoping that this time the real thing does work, John. So if Leandri can just confirm, or you, that it is all being shared at the moment.
Thanks, Ben. I can see it.
Okay. John, thank you for the invitation. Anecdotally, people normally sort of refer to trauma counseling, that one of the effective methods of getting over trauma is to talk about it often. And I often, when I'm invited to talk about the COVID pandemic and the lockdown period, it's almost a bit of trauma counseling in terms of reflecting on what we went through in those early crazy days in April 2020. But it's really a privilege to talk to you this morning. The framework that I'm going to be applying in terms of sharing some of our insights is to just recap quickly for all the participants the effects and the basic structure of the Sakuma Relief Program, and also the business partners relief programs that we launched and executed in that period. I think it provides the context to look at the outcomes, and to also look at what sort of insights and lessons we learned and what we are trying to take into the future. So I'll specifically cover some of the outcomes, the lessons learned, and then some comments at the end around what we think we should do as a subsector, as an industry, as a body, to ensure that there's a readiness and a playbook that's being created for future crises. But allow me to reflect quickly on how the Sakuma Relief Program was conceptualized and created. At around about the 15th of March, I think Johan Rupert, who is sort of well known within the South African business environment, reached out to business partners, and I think he saw the looking at worldwide trends, he saw the threat coming to South Africa, and he requested from business partners a concept plan about how we can actually assist SMEs, and specifically looking through at protecting jobs. And we went into thinking mode and had a few versions of a plan that we submitted to him. And just after President Ramaphosa announced the lockdown on the 23rd of March, we suddenly had the privilege, the task to execute the plan that we thought we were developing for cooperation between the private sector and government. But by the end of March, John, the Remgro group, Mr. Rupert himself, and other donors committed more than 1 billion rand to this Sakuma Relief Program, I think, which is again exceptional in terms of the generosity and the philanthropy that is evident in South African society. By the 3rd of April, we went live with a website, and please be reminded that at that stage, we were in a complete total lockdown in South Africa. And the website invited applicants to submit their applications to receive some of this relief funding. By the 6th of April, we were oversubscribed in terms of the billion rand that we had by about 6 to 7 times. It indicated the dire need and the desperation that was evident in the SME sector. And we had to suspend those applications. But subsequent to the 6th of April, we requested SME owners to leave their contact details, so that if there are more capital available, or if we do have additional resources, that we can reach out to them. And in the course of the next 10 days, another 35,000 SMEs left their contact details on our website. Again, I think significant to see how big the need was. And as a reminder, in those early days of lockdown, there were no clear indications as to how long this is going to last, what other relief efforts, when the economy will be opening up. So a lot of uncertainty and volatility. We were fortunate with our processes and our internal workings to make the first disbursement to an SME by the 14th of April. And in the first 100 days of lockdown, we managed to disperse more than 300 million to quite a number of SMEs. A quick reference to what we offered the SME industry at that point in time. The program that we conceptualized essentially targeted small business, formal small business owners, but also sole proprietors. And sole proprietors received grants, but we also structured the offering to have a loan size between 250,000 and 1 million. For the first 12 months after the loan had been fully disbursed, there were no repayment obligations. So nobody had to pay back anything on that loan component, and there was no interest charged on any of the disbursements that we made. From month 13 to 48, the next 4 years, there would be interest, and there are interest being charged on those loans. It's linked to prime, and the repayments, as I mentioned, will happen over those 36-month period. An interesting feature of what we developed was to try and get as much traction as possible. We structured the program that you would not receive all the money in one lump sum, but we essentially created structures that 4 equal monthly disbursements would be made after approval to try and ensure that as many jobs could be saved as possible. So if for whatever reason the business was dying, that we then would stop disbursing to that specific business and keep the capital perhaps for other businesses that are still in need of capital to try and save them. We had no security or collateral as a financial institution. That was a bit of a leap of faith for us to place money in the economy, but have no legal framework necessarily and collateral to back up the recovery of those funds. But we did have in that whole lockdown period, with digital communication and digital technology, we had signed loan agreements with all of the entrepreneurs. The effective cost of this offering was around about the repo rate. So depending on how big the loan was, at the prime rate for only a portion of the period, the effective cost to the SME entrepreneur was approximately the repo rate. The criteria or the conditions that we used to qualify the thousands and thousands of SMEs that applied was essentially along 5 specific dimensions. We conceptualized and thought about it, and we said that what we should do is to at least get a sense of whether the business was viable and profitable prior to the onset of COVID. Because with relief funding, you try and save as many as you can, but you can't be trying to bail out an organization that was already struggling and it's perhaps already insolvent just prior to COVID. So one of the criteria we had was to ask for audited financial statements no later or no older than February 2019 for these formal businesses. And we also wanted some sense of how the business was doing prior to COVID and asked for management accounts. We insisted on good corporate citizens applying, and one of the criteria was to ensure that the company was tax compliant. Specifically to see the extent to which jobs could be addressed, we requested those entrepreneurs to provide us with their latest EMP 201, which is a form that indicates all the payroll taxes being paid to SARS. We also wanted bank statements to provide proof of that business as trading. And then if they were available, a rent statement, as well as credit agreements that they might have. So these are the criteria that we insisted in lockdown, not having the ability to go to a business, to go and assess whether the business is a good business, etc. And if, based on these criteria, most of those tests or criteria were met, we would have essentially approved the level of funding by looking at how much that business needs to survive and protect jobs for 4 months. So that's essentially what we conceptualized. And all of this had to be executed with employees and processes and systems that didn't exist before the COVID pandemic, but had to be developed in record speed. The outcomes of those initial phases, as I mentioned earlier, 30,000 applications in 3 days. We disbursed around 840 million of that initial donation for the Relief Trust in the first wave of applications that we processed. And we assisted 3,917 SMEs in that period. This would be from April round about to August, September in 2020. By getting detailed information from those SMEs, we essentially quantified that around about 32,000 jobs were, I put it in abbreviated commas, saved, in the sense that funding was provided to that SME to continue paying salaries. So this is in essence what the Sakuma program is all about. As we executed this program, and John, this is specifically what you wanted us to comment on, we learned a lot of lessons, a lot of insights were gained from looking at how this program was rolled out in the unique and special circumstances that prevailed in that COVID pandemic. And one of the key points I would like to make to the audience is that in those lockdown conditions, which might appear again, we might have another COVID crisis, but reliable information for an SME is absolute gold. So if you have readily accessible bits of information to look at relief programs, supply those decision makers with the information, your chances of benefiting from that, it increases dramatically. For us as a financial institution, the big challenge that we faced is to try and assess what information in this context is actually relevant. What do we need to look at in order to execute the task that we were asked to do? And this is again bouncing forward to what we think should be happening in the future in terms of subsectors of the SME industry, to look at what is the actual information that could give a lender the kind of comfort to disburse funding in a very difficult period. The other insight that we gained from that process in complete lockdown conditions is the fact that we made assumptions, not that we had a lot of choice, but we made assumptions around the SME's ability to access information, to access the funding in a complete lockdown environment, i.e. you had to use the internet, you had to be connected. In hindsight and in our post-mortems, this assumption, I think, is something that we researched and found that a lot of SMEs did not have readily available infrastructure and connectivity to access the relief efforts. Even though we look at society today and everybody's got a smartphone, and we tested our applications, whether you can access them from smartphones, it is, in hindsight, it's tragic, but to expect that all SMEs would be in a position to access a relief effort through the technological infrastructure and communications technology that exists in an economy is perhaps not a very safe assumption. The other part that I think was unique from that period in terms of how it was executed, one of the key drivers for us was to create some certainty and some relief within the SME sector. So we were working at warp speed to try and get a solution to the market, because the levels of uncertainty, the levels I mean, the press was just dominated by COVID internationally, but there was nothing coming through apart from the president speaking about the Solidarity Fund, about what tangible relief and tangible support is there. And that drove us to try and get to the SMEs as quickly as possible. But within this context of uncertainty and volatility, and we all reflect back at COVID about the other traumas that it caused, there was a lot of desperation, and we had to be quite agile to ensure that whatever we offered to the market cannot be, you need to be careful how I put this, cannot be embraced by unscrupulous characters. So there was a lot of verification done so that we can save and address and support SMEs that are real SMEs and not maybe a fake SME, if that makes any sense. The normal lending conventions that you develop as a financial institution, to a large extent, became irrelevant. So if one looks forward at a crisis and you think about how do you need to address this or roll out a relief program, one needs to take your conventional wisdom, put it on the back burner, and really look at the situation, the ecosystem, the circumstances that face you, and devise a way of providing those financial assistance that addresses the appropriate circumstances that you are facing. The other point that we learned, or the insight that we gained, is that in the context of a national disaster, where there is no boundaries to the geographical, the industry, or the sectors of the economy that are affected, if one goes to the market or communicates a broad or public offering, it does result in a lot of stress points. And one of the key insights from our experience has been that there has to be a very specific and targeted focus to look at the different sectors or the chambers or the institutions that are active within the broader economy and work with them to ensure that appropriate and speedy solutions are provided to subsectors. In essence, what I'm saying is to have one single offering, which is the only one we could create at that point in time for the broader SME sector, creates a lot of stress points. And it would be better if we ever have to face it again, to have one for the manufacturing industry, the hospitality industry, etc. So that's part of what we would recommend and what we are working on at the moment. And as an institution, it was also critical for the success of this program that you can change the requirements and change what you do while you are executing. There is no time and no capacity to go and have a brilliant plan developed, tested, and flexed, and then roll it out like you would do in normal circumstances. This had to be done quickly. The need was desperate, and we wanted to make a big difference as quickly as possible. I think from the relief program insights, and this is a very critical post-mortem that we did, and I think it resonates probably with some of the audience members that might have applied or did get some benefit. But these were the main insights that we realized from the post-mortem assessment of how the program operated. A key factor that we were criticized initially for, but I think has stood the test of time, was in rolling out this relief program to put an obligation on the beneficiary to repay some of the capital. Now, you would argue that in a relief situation, why would you want the client to repay? There were two very good reasons for it. Number one, if there is no obligation to pay, then how do you decide how much money do you need to provide to each SME? Because everybody, if it's for free, is going to try and take as much as they can. Number two, it also tested the business's ability to recover, and at the point that they are recovering, by providing some repayment, you're creating capital that is available for the next crisis, which I think has been one of the key differentiating factors in the Sukuma Fund. Because as we speak today, John, I am always surprised if I look at the numbers to see how many of the relief program beneficiaries have bounced back and are starting to pay back the Sukuma funding. It is inspirational, and it provides capital for the next crisis. So we think that that's a criteria that once you start handing out money under no conditions, no obligation to repay, I don't know how a program would work. But that I think is a principle that we would always argue is an important one taking forward. They don't have to repay immediately, and a lot of the businesses that we assisted failed, and then obviously there is no ability to repay. But it's a key design criteria that we think should always be repeated. In hindsight, trying to get to valid and well-run SMEs, good corporate citizens, we designed into our criteria a lot of compliance information. And in hindsight, we think that perhaps that was maybe too much. To insist on audited financial statements and to insist on tax compliance certificates did disqualify quite a number of really well-run and well-capacitated SMEs. And in hindsight, if we had to do it again, we would perhaps not insist on so much compliance information. I mentioned the assumptions regarding accessibility and whether they were accurate. We think that there has to be different ways and means of reaching the SMEs, channels to get access to information, and that a broad assumption around internet access or website functionality was perhaps not accurate. And then the last two, that was actually quite tragic, is that while we were having the privilege of looking at the financial statements and the business model of many SMEs, as a financial institution, we would have loved to fund them for expansion capital, to recapitalize their balance sheets. But essentially, they were extremely fundable, but they could not qualify in terms of our criteria, and we had to apply our criteria quite strictly. So that's the one incidence that you have a lot of really well-run businesses, but they are not necessarily compliant. They don't necessarily have audited financials, but you could see into the business that it was a really, really good business. And then the opposite, or the corollary to this, and that was also quite evident in assessing so many businesses in that period, is that the South African economic conditions prior to COVID, and we tend to forget about that, were really dire. We were in technical recessions. We were downgraded from an investment status by Moody's and S&P. But many of those businesses, if you look at what they were doing and where they were operating, they were running into massive headwinds from a structural and an industry perspective. And they should have been fundable. So they were compliant as good corporate citizens. They gave us all the information. But at the part that you looked at what was happening to them prior to COVID, they had already taken a huge amount of stress. They were in distress prior to COVID, and they needed non-COVID relief funding or startup funding. And that was the other big insight, that as long as the South African economy doesn't function the way it should, businesses will suffer. Dr. Tabi Leoka was one of the advisors to the Sukuma Fund. She's a director of the SBI. She provided huge support and insights in steering the Sukuma Fund through that period. And I thought it was valuable to take one of the op-eds that she wrote and the emphasis that she placed on saving the jobs within those businesses. And that was a guiding principle for Sukuma then, and it continues to be one for the fund because it's still operational, in looking at how do we ensure the protection of jobs through the survival of businesses. A quick note, just to give you some other context, Business Partners itself, none of our clients were essentially beneficiaries of the Sukuma relief effort. We put a Chinese wall between our clients and the Sukuma efforts, but we constructed and developed our own relief programs and provided repayment relief and holidays, probably in excess of 300 million, just over 300 million rand. We had a restart program starting at about November in that period, where we disbursed to our existing clients working capital injections to get them operating again, probably just in excess of 190 million. Rental holidays to our tenants, which essentially was revenue that we forego in that COVID lockdown period, roughly about 30 million rand. And then also rental relief to allow them an extended period to not incur the rental and then start paying it back. But I think the most significant aspect of the Business Partners Relief Program over the last 12, 18 months was the additional assistance and mentorship and support that we provided to the clients. And it's a pleasing thing that I can share, John, with the audience, and that is that we have been amazed by the extent to which a large component of our clients have started bouncing back. It does give you confidence for the future to see to what extent innovative SMEs can actually overcome immense challenges that were evident through this last 24-month period. A few sectoral insights. I think I'm still sticking to time, so shouldn't rush too much. And we've published some of our insights in terms of industry available information, but the value of being a good corporate citizen is normally saluted and celebrated under normal circumstances by ensuring that you treat your workers fairly, you pay your taxes, and you comply with your local regulations and rules. But in the time of a crisis, I think this became especially important. And there's an initiative with my colleague that's on the seminar today that is running to try and ensure that we celebrate, highlight the value of being a good corporate citizen, and also assisting businesses in getting their compliance levels and their governance levels improved. One of the tragic things that we experienced in the COVID period was a recognition that very little was being done and could be done for the informal sector. And the informal sector in the South African economy, as an emerging market, as a developing and growing economy, is critical to feed into and to become the chain for creating more SMEs. And in hindsight, this is, I think, a national priority to see to what extent we can improve the understanding, the amount of support and services that are available to ensure that informal businesses that are flying below the radar for good reasons often are being supported. If you look at the disruptions caused by supply chains and getting food into informal areas, these organizations play a vital role. And it is a key focus area for business partners going forward to see to what extent the offerings that we have and the support that we can provide can be targeted at the informal sector as well. Another sectoral insight, and I think this is essentially, John, what you are contributing to today, is to look at the SME sector and to ensure that the leadership, the coordination, and the collaboration between all the different role players is strengthened, and that it becomes a proactive approach to anticipate the next crisis, so that we are more ready, that we are more responsive, and that the agility with which the broader support framework operates at the next crisis is actually improved. A few comments from my side on the current status. I think it is tragic, but we need to recognize that a lot of businesses closed or died, and it is way too many. We should have saved a lot more. Every business that goes under, stops operating, means jobs are lost, and it becomes much more difficult to restart that economic activity that was essentially embraced by that specific business. Other insights that we've developed over the last few months, as I also mentioned earlier, is it's fascinating to look at well-led businesses and looking at them right now and see to the extent to which, number one, COVID affected liquidity in that business. So you could clearly see that in those lockdown periods, revenue, turnover, and income decreased dramatically. But often you look at those well-led businesses and agile businesses, and you can see how they managed to overcome that liquidity shortage by often double dipping in the relief efforts. So they would essentially get from 2 or 3 institutions some sort of relief. They would borrow or access capital from family or friends, but those well-led businesses are clearly evident. It's clearly evident how they navigated and anticipated the crises that were going to happen. In our portfolio, which I think is geographically and across sectors very representative of the broader SME sector, we are seeing a very specific bounce back in the operational activities, the turnovers, and the activities of those businesses. And they are religiously and much better than 12 months ago servicing their current obligations. They are slowly but surely addressing those payments that they could not be during the pandemic. And as a financial institution, walking the journey with them, I think, has stood them in good stead, also stood us in good stead. The hospitality industry, I think, is underserved because we recognize that those cumulative, repetitive lockdowns really had a massive impact on the hospitality industry. This would include the restaurant hospitality in the form of guest houses and hotels. And I just wanted to share with the participants that the Sakuma program is currently busy with a hospitality restart program that is really gaining a lot of traction. We have approved just in excess of 30 transactions, around about 20 million, and we anticipate that this would probably in the next 2 months reach quite a sizable 150 million, which is specifically targeted at not capitalizing or recapitalizing the business, but providing the necessary capital, working capital, liquidity for that business to start operating at a more efficient, at a higher efficiency level. And I mentioned earlier that the Sakuma Relief Program and the Sakuma Trust, with the capital that's being repaid by the SMEs, is also launching, in the process of executing, a program that highlights the importance of governance, the importance of being compliant, and providing assistance to those SMEs in less formal sectors, less formal structures, to be funding ready. I think it's not that we're anticipating another crisis, but I think it's an important component to improve businesses and make them more resilient if they have the ability to access funding quicker and to access funding with more success. I'm almost done, John. The last slide on what we think is necessary to make us ready for the future and be more effective in dealing with the next crisis. I mentioned that between the SBI, the business partners, and government, or SEFA. I think we've got Mxolisi on the webinar later on. He's a director of business partners. But we need to work together more closely to ensure that there's a coordinated response to whatever crisis. So the playbook and the recipe for saying, this is how we address future crises. We have the luxury now to develop those playbooks with the pain and the recent memory of COVID-19, that we can actually create that playbook. And it might only, let's pray, it comes only in 10 or 15 years from now, but it will come. But then at least there would be a recipe with the lessons learned from this disaster, from this pandemic, to ensure that our responses are better coordinated, better aligned. We tried in the lockdown to coordinate, for instance, with the Department of Small Business to ensure that we don't have too many clients, and the term that was phrased was double dip, and get relief support from Sukuma, and then also get some from SEFA, and also get some from the Solidarity Fund, and also get some relief funding from the Future Trust, which is the donation by the Oppenheimer family. But it became incredibly difficult to try and get some interfaces through to Home Affairs to try and vet IDs and vet people, and it was essentially impossible. And it would have slowed everybody down to try and coordinate that their decisions should first be vetted or ratified by other institutions. But if we get those plans together, and I think the SBI could play a huge role in cooperating with a financial institution like Business Partners to ensure we align our plans. I mentioned this also before, but I think it's critical that we look at the hospitality industry, for instance, the personal services industry, and have industry-specific representative bodies that know exactly who is part of that industry. Are they participants, and how do you then shape the set of criteria? How do you get funding and support funding quickly? The personal services industry was probably the one that lost the most jobs in that lockdown period. And we tried our best to find a representative body that could work with us to make sure that the personal services industry gets some support. But it was not easy, and we were not successful, I have to confess. I think with the DTI, with Treasury in the room later, I had to get this one in, John. I think the ecosystem for SMEs is extremely reliant on the institutional capacity that we have in the broader economy. If local authorities don't work, if all the institutional frameworks that make up that ecosystem is not running at an efficient level, it puts a burden on all the SMEs. But in order for us to navigate the next pandemic, the next crisis better, it has to be a business-friendly and supportive institutional framework within which we work. And there needs to be closer recognition, better recognition, I think, from all players about how vital SMEs are in creating jobs, sustaining jobs. The SBI has as its slogan, the voice, the big voice of SMEs. We need to work with you to ensure that we have a single, maybe there's scope for 2 or 3 voices, but there has to be a combined single voice so that the sector as a whole doesn't get lost in the bigger political, big business narratives. Those were the things that, if those had been better at the onset of the pandemic, I think we would have saved a lot more businesses. And we need to take those lessons and work right now to try and improve this. There's a lot of resources from Business Partners' perspective being channeled into this initiative. But those were the salient bits, John, that I could share with you today. I think I am sticking to my time. Maybe I'm a bit over, but yeah, that's what I had to share with you. Thank you, John. And thanks to the participants for listening.
Thank you very much, Ben, and thank you for answering some of my questions proactively. It's almost as though you could read my my mind. But we do have some questions that have been fielded by colleagues who are on the question about readiness for the next crisis, because that's very, very important. And I think also I was quite keen to hear from you about the insights that you are getting, whether people are bouncing back, whether SME owners are bouncing back from the pandemic, and just the general state of the ecosystem, whether it's getting more resilient. Now, I have two questions of my own. The first one is business partners, other than the Sukuma Fund, focusing on the fragility of the hospitality sector? And I'm saying this informed by an experience that I had most recently. I came back from KZN, and as I was leaving KZN, there was an announcement that for the next few months until the end of the year, there will be 5-hour water cuts. And those were going to affect the tourism sector, which was just emerging from the devastating floods. And then the other question that I had for you is there room for all those financial services support players like yourself, the South Africa Future Trust, to collaborate without necessarily colluding, to collaborate, I think, in future crises when we do face them, in the unlikely event that we do face them. Thank you, Ben, and then I'll go ahead and read some of those that have been posted on the chat. Thank you, just my two.
Thanks, John. I'm going to answer your second question first. You'll be pleased to know that we are working very closely with the Future Trust. Their model was very different, but we only started working together after the pandemic. And there are an alignment in terms of what needs to be done to try and support and improve certain conditions on the SME industry in the institutional capacity, what needs to be prioritized. So I do think that from a funding perspective, there are ways and means that you can have different financial institutions participating in the same relief effort, because you could carve out the vested interest and the self-interest, which every business probably has. But if there is a unified approach to try and solve a problem or a crisis like the pandemic, there's definitely scope. We did try in the early stages of the pandemic to work together with the big financial institutions, but the regulatory challenges that they face and the regulatory frameworks that they need to comply with made it very, very difficult, and often will make it difficult for different financial institutions to work together, because you are rightly pointing out, could be seen as collusion. But there are mechanisms and vehicles and structures where both institutions operate as administrators rather than lenders, and then you can do it. And those are the playbooks that we are creating for the future. But we are cooperating with the Future Trust in seeing when they're going to wait a while longer before any capital comes back. But yes, so the answer to that one is yes. To go to your first question, as I mentioned, the hospitality industry has probably been the one sector that has been the most vulnerable and the most severely affected. The extent to which other stuff, electricity and water is the big crisis that South Africa is facing right now with electricity, and water will become an increasingly big challenge. The Business Partners itself has launched the Green Building Program with the assistance of the IFC. So that's available within the market, and there's a lot of information available. But in essence, John, what we're trying to do is to assist with subsidized funding and the recovery of the cost to green the infrastructure that a small business in the hospitality industry has, whether that's water reticulation, water savings, electricity savings, or completely going off the grid, a whole range of initiatives to make, especially the hospitality industry could benefit a lot from being less dependent on the general economic supply of those vital ingredients to run a business. So yes, there is a lot of resources, a lot of planning going into it, and there are offerings right now that could assist an SME to try and make themselves less dependent on general water supply and electricity supply.
Thanks, Ben. I think you've touched on this question already, but Tebogo Mokoena from VuTV Business News, which focuses on covering the SME segment of the economy, asked, regarding the informal sector, what actionable insights did you gain and what future assistance models are you looking to implement for the informal sector?
Let me cover the one insight. And this is very personal and very close to home for us as an organization, because we've for the past 40 years focused on small businesses. If you deal with an informal sector business, access to information to make an informed investment decision, lending decision, is your biggest challenge. So gaining access to an understanding of what the trading record and what the business's turnovers, etc. are, that's the one thing that we are working on at the moment. We also, I think, discovered in the lockdown period that there's very little representation, very little a governing structure that could represent a number of SMEs. You talk to the individual business owners, you hear their stories, but to try and get a sense of the collective challenges that they face, it's difficult to do that. So that is something that we are researching at the moment, that we're trying to unpack, to come up with innovative solutions to try and address the very, very specific need. Might not be business partners, but at least we can actually unlock the problem or define the problem better in saying, how do you fund, how do you provide access to funding, and what other support is most critical for an informal business that essentially gets devastated by load shedding or gets devastated by a lockdown. I think that was a vague answer, but I'd offer direct contact and we could perhaps debate the issue a bit more, but that, yeah.
Ben, I think I also appreciate the fact that you have answered the question about the playbook for the next crisis. And if you could also get some of your colleagues to drop on the chat box, I think the tourism facility, as well as some details around Sukuma Trust, it would be very helpful. I see on the chat box, people are requesting those details. Ben, thank you so much for coming through, and I really appreciate your time and insights. Thank you very much. And in SBI, you've got a willing and a capable partner. It's only a matter of us collaborating, but we are as close as you are to us, and we'll be reaching out with a hand to you so that we collaborate some more. This is an important segment of the economy. It requires cooperation instead of competition. Thank you, Ben.
Thank you, John. Looking forward to it. Thank you.
Thank you, ladies and gentlemen, and thank you to Ben again for having graced us with a very detailed and comprehensive presentation. Like we said, the presentation will be made available and will be available on the Business Partners website, and it will be available on our website and to all the participants. It has become tradition for these dialogues to include one of two components. Either we have an SME owner or owners, or we feature a segment that will have an empowering value for SME owners going forward. Today we have two such segments. The first one, we are delighted that our next speaker has agreed to join us. He's a qualified chartered accountant, and he has decided to use his expertise and experience to assist SMEs to be funding ready. Lekhateng Toka, the founder and MD of Accord Advisory, is also contributing his expertise to the public sector. Lekhateng, over to you and welcome.
Thank you very much, John. Thank you very much to the previous speaker, and good morning to all the participants. Just want to make sure that I'm audible. John, can you hear me?
Yes, I can. Thank you. Go ahead.
Sure. So I wanted to take this time to talk through the basics of being funding application ready. And as John and Ben previously highlighted, I mean, some of the issues that face small businesses relate to the finance function of a business. Ben talked to annual financial statements, the critical need for reliable information, whether they be audited, reviewed, or otherwise. So those are some of the aspects that I'll try to delve into and highlight the importance of it to see through a funding application process and hopefully, you know, improve the chances. So the presentation that I have put together is a little bit wordy, but I took into context the fact that it will be shared amongst the broad audience, and some may or may not have access to the actual presentation and the delivery of the presentation. So I think one of the key places to start off is where we have a strong business plan or business strategy. In the application for funding, the financiers need to see what the business is about, its historical trading, and the purpose of the funding needs to be clearly demonstrated and communicated within the business plan. I mean, it's important to highlight that because all of the aspects that are included in the business plan are assessed by the financiers. And again, you know, honesty and integrity in the actual information contained in there is of utmost importance, you know, because I think more than the financial information that's provided, that is the key aspect and non-financial criteria that financiers look for in a business. And I mean, talking to the purpose, this could be many different forms, and Ben talked about, you know, working capital, expansion financing, but you can also see other forms for funding or other reasons for applying for funding, which, you know, include refinancing existing debt or purchasing fleet equipment, etc. So those are some of the various pieces that are looked at. There are a little bit more other pieces, but I think for small businesses, those are some of the key reasons for applying for funding. Now, we talked about the importance of the financial information that is also given to financiers, and, you know, key critical information Ben talked about is historical management accounts. Is audited financial statements, and we will delve a little bit into that into the next couple of slides. So in designing and in preparing for funding, you know, a strong finance function should be able to deliver historical management accounts, whether that be monthly, quarterly, or semi-annually or annually. And the financiers look for your ability to be able to repay the funding. And that is deep rooted in the company's ability to forecast. So in some instances, it is very key and would help in terms of the funding application to have management accounts that can demonstrate their company's ability to forecast by looking at previous forecasts against the actual performance. So I've included an illustration just on revenue to show what may or may not be, you know, beneficial for small businesses in terms of supplying the historical management accounts. So, and on the right-hand side, in terms of the ability to forecast, you know, depending on the term of the loan, financiers would want to see, you know, your forecast profit and loss, and forecast cash flow. And in many instances, the forecast cash flow is designed in such a way to see how much cash is actually in the business that is available to finance or to service the debt that could be provided by the financiers. And I've illustrated an example in the table on the right to show, an actual column to show how to lay out the information so that it's readable and understandable to financiers, as that is what the main focus will be. In certain instances, some financiers may request what we call a 3-statement financial model, which basically forecasts into the future your profit and loss statement, your balance sheet statements, and statement of cash flow. Moving on to the next piece, being annual financial statements. The previous speaker, Ben, talked about, audited financial statements, and, some of the questions in the chat that I noted, person noted that audited financial statement create a cost, and that also inhibits the business in terms of performance, and in terms of which service providers and which expenses to incur and not incur. And Ben talked about, maybe in hindsight, they might relook at that criteria. But what is key as to what the financiers look for in that is the performance, the annual performance of the financial company, has been reviewed independently, which creates a level of reliability in the financial statements. And this speaks to the fact that the financial statements fairly reflect what is actually happening in the company. They fairly reflect the financial standing of the company. And that is very critical for financiers to look at. And there are different forms of assurance engagements that one can enter into, being agreed upon procedures, independent review, or external audits. And all of those provide different levels of assurance. However, the more assurance you can get, the better for application for financing. Now, on the right-hand side, I wanted to highlight financial covenants, which are specific key criteria that financiers look for to measure the financial health of a company and to put in place conditions that businesses need to meet throughout the term of the loan in order to, keep the loan as it may be. And they're married, and they're different levels of covenants. But I just wanted to highlight, some of the key covenants that they look at. And these are some of the aspects that financiers will calculate and will look to determine once you have provided your financial information to them. And I think, trying his best to make the job easier for financiers increases your chances of getting financing. And I mean, I've highlighted some of the key ones, which is your earnings before tax and interest over interest expense, which just clearly demonstrate how many times you'll be able to pay back interest on the specific loan if the conditions of this specific loan agreement or financing agreement require you to make payments. I've illustrated net debt, which basically stipulates how much debt is in the business after you've paid off the cash that you have in the business. So those are the number of financial covenants I just wanted to highlight. They may be more depending on the circumstances around the application of the funding, the history of the business, etc. And lastly, I just wanted to highlight, security and collateral. and Ben touched on it in saying that, you know, and I think it was an exception because of the time that we were in during the COVID pandemic, that they took a leap of faith in terms of not requiring collateral or security, which is in many instances very, very rare, as the security and collateral is the financier's way of recovering their loan if there's a situation where the small business is unable to repay the loan. And trying to find ways in which to demonstrate the available security that is within the business can help financiers make their job easier in terms of finding security within your actual business. And security and collateral comes in many forms. Financiers' most highest preference relates to cession or pledging of assets, which basically gives away the right of specific assets within the business if there is a default or if there's an inability to pay of the small business. There are various levels of ways in which we can determine what security can be provided. And I think trying to think about that before approaching financiers can largely help in terms of the application for finance. And those are some of the basic key essential items I just wanted to highlight. There are more pieces, and Ben talked about some of the other pieces that financiers will look at in terms of and for finance. So I just wanted to thank everyone for giving us the chance to talk through some of the basic key aspects. Within my presentation, I've highlighted some of the information and content details that can be given in order to access us. So John, I think over to you. If there are any questions, I'm happy to deal with them.
Thank you so much for a very detailed presentation. With your permission, of course, we will share the presentation with our guests today and all the delegates to this webinar. And I'm glad that you've also put your contact details so that they can interact directly with you. Unfortunately, we're running slightly behind schedule. So, but I think we should carry on the conversation beyond the webinar. So let me just move on to the next speaker of the day. The next speaker of the day comes from a very important department, the Department of the National Treasury. The National Treasury has built a reputation over the last 28 years, a very solid reputation as the bulwark of our public finances. And for that, we owe them a debt of gratitude. When COVID hit our shores in 2020, March, the President turned to the National Treasury to cobble together a socio-economic package to save both lives and livelihoods. We invited Ismail Mouniat, who's the Acting Director General, to take us through the lessons of designing and implementing the relief measures during COVID. Unfortunately, this morning, we learned that he had taken ill. Fortunately, though, we managed to get one of his colleagues to come in and step in at short notice. Our next speaker has vast experience in banking and financial markets regulatory around the world and here in our country, and has looked into solutions to the challenges facing SMEs. Vukile Davidson is the Chief Director responsible for financial markets and stability at the National Treasury. I should also say that with the team at National Treasury, we really feel there are adults in the room. Welcome and go ahead, Vukile.
Thank you so much, John, for having us participate in this in this webinar. Like you've already highlighted and explained, and unfortunately, Momo was unable to attend given his illness, but I will gladly, using his speaking notes, and hopefully reflect on what he was intending on transmitting to the audience today. Just before I start, I'd just like to just sort of mention that the thoughts that and ideas that will be contained in the speech are my own and do not necessarily reflect the views of National Treasury, the Minister, or the government as a whole. So I want to begin with kind of talking about some of the structural challenges facing SMEs. And I know that the core focus of the session today is really about COVID and COVID response. But I think like the two previous speakers have outlined, it's very difficult to separate the cyclical challenge that COVID represented from some of the really important structural challenges that are facing SMEs. And what we've heard from both speakers is that really informality hinders the development of SMEs, and that government should be focusing on a way to simplify, either through digitization and other policy intervention, the cost and the other impediments for formality. You know, the pandemic, but also not just the pandemic, in fairness, but also the July riots last year and the KZN floods more recently are demonstrating the disadvantage of the continued informality in SMEs for policymakers to reach affected SMEs with policy interventions. In 2020, the FinScope Small Business Survey revealed that about 58% of businesses operate as informal enterprises in South Africa, and that only 34% of businesses use formal financial accounts in their normal business operations. This blend between consumer and commercial credit makes one type of credit indistinguishable from another. This causes several challenges, such as which we're talking about now, the ability for policymakers to reach affected businesses in times of crisis. But it also limits the ability for small businesses to participate in other opportunities that require a level of formality. It also increases the risk of certain types of businesses, informal businesses, being prey to excessive and bad market conduct practices. The benefits of formalization, I think, are well known and well understood for business owners. There is a series of reforms that we're currently contemplating to help further incentivize or at least reduce the limitations for small businesses to formalize. And what we mean by formalize is not necessarily having to a burden similar to a listed company. It should be proportional, it should be simple, it should be easily accessible, and it should be done once or twice, once, but of course, whenever significant information changes in relation to the entity, there should be a similarly easy and efficient way for those small businesses to change their information. Just moving on to the SME lending landscape, and this links to the formality question. It's become clear to us, and this was echoed by the two previous speakers, that larger and more formal business access finance more easily. Firms are more likely to take on debt when they are larger, with the percentage of medium, small, and micro enterprises with formal credit being 85%, 74%, and 26% respectively. Credit is mainly provided by banks, with 35% being provided under on the balance sheet or in the name of the owners of the business as a personal loan. This again is an area that requires some policy intervention. It is clear that for many individuals who are looking to start a small business, leveraging on personal finance is the easiest way to access funding. And this usually comes in the form of pledging personal assets, homes, vehicles, etc. But I think what we've learned in times of stress, the close commingling of personal and business finances can make it difficult or constrain the ability or willingness of some businesses to try and access additional funding. And in some cases, I think this leads to a higher level of businesses exiting than would otherwise be the case. So having maybe one more additional point to add about the structural nature of SME lending. It's just that the ratio of non-performing loans in SME is high, and this is a reality that we must grapple with in designing appropriate policy responses. And then that of course leads to overall the cost of financing being high for small and medium enterprises. There are, like I say, ways in which we could mitigate and reduce some of that cost through an appropriate collateral framework, for instance, and increased formality, as well as non-financial services that should be provided to SMEs. But this high cost of funding does reflect a reality, which is that for the vast majority of new enterprises, most do not survive the first 5 years of their lives. So the policy interventions, I think, need to be quite clear. It's providing SMEs with an appropriate cost of funding needs to obviously reflect the inherent riskiness of the activities. A disproportionate subsidization of SMEs, although would result in some potentially public policy benefits, for instance, having these SMEs established and the jobs that would then follow, we should also sort of balance that debate with a recognition that, at least for finance that comes from banks, that funding is provided by ordinary depositors, and they expect obviously that their deposits would be safe. So we need to come up with an appropriate way of balancing the cost as well as the providers, the interest of the costs and providers of funding for SMEs. It's not an impossible task, but this is the reason why I sort of highlight this is that this is not just a challenge for South Africa. This is a central challenge for SME finance in most other jurisdictions as well. Moving on rather, John, to the cyclical challenge that the COVID represented. Now, there were a series of interventions that were facilitated through the official sector. The Department of Small Business, for instance, launched a debt relief fund for SMEs. There were other private sector-led interventions. These were augmented by some other private sector-led interventions, some of which we heard earlier this morning. From the Treasury perspective, though, John, the key intervention was the Loan Guarantee Scheme, which we launched in 2020. The scheme was aimed particularly at helping businesses, SMEs, really, access funding at affordable rates to help them survive the worst parts of the COVID lockdown. Like the previous speaker highlighted, the eligible businesses had to have been in existence prior to the imposition of lockdowns and had to have been creditworthy before the imposition of lockdowns. A conceptual question that we were faced with in Treasury was in design is really what we were trying to do. So there are a host of structural interventions, including a dedicated government department that aims to try and improve the structural operating challenges of SMEs. At the National Treasury, what we thought our best contribution would be to, as much as possible, ensure that where the ordinary functioning of credit markets and access to credits, that SMEs would be able to access in normal times, a sort of but-for test. And what I mean by that is, but for the event of COVID, these entities would be able to access funding through banks. Our intervention was targeted at facilitating and ensuring the continued orderly functioning of those credit markets, so that SMEs would be able to continue to access funding in line with the conditions and the environment that faced them before the impositions of the hardest lockdowns, of the more severe part of the lockdowns, which was early 2020. So the 2020 loan guarantee scheme was also a supplementary mechanism to other regulatory interventions, including interventions by the Prudential Authority, which allowed banks the space and time to put off recognizing losses caused by businesses not being able to trade and therefore repay loans. This provided the ability for banks to reschedule loans, giving businesses vital space to restructure. These measures supported loans to the value of around, in excess rather, of 600 billion rands and represented the preferred relief mechanisms for most SMEs, which really isn't surprising given the uncertainty about the depth and the severity and breadth of lockdowns at that period. Many SMEs who of course have commingled private, their personal and their business finances, were really stressed about their future prospects. So what we saw was that most businesses wanted to reschedule existing liabilities as opposed to taking on additional liabilities in the form of loans. And we think that this is a rational response, and we were very happy to see the very large take-up of this facility facilitated by the Prudential Authority. So on the loan guarantee scheme itself, which was a supplementary measure, we were able to disperse around just under 20 billion rands to about 18,000 businesses, individual businesses, with an average loan amount of about 1.2 million rands. And although the loan guarantee itself wasn't the principal tool, the debt rescheduling instrument was the principal tool, we still think that the loan guarantee scheme was highly successful. You know, some of the metrics that I've just highlighted compare, I think, really well when put next to some longer-term structural programs that have been in place for many years. So we think that the combination of these interventions, the regulatory and the fiscal overall provided much needed and significant relief to small businesses in particular. I'll just add maybe one other regulatory intervention, which hasn't narrowly have to do with sort of SME finances and SME bank balance sheets, but I think what we found in our assessment following some months ago, that this was also really important and helpful, was just clarifying the role of insurance and business interruption insurance for those SMEs that had such cover. Right. So we're now in the post the period, not post-COVID per se, but certainly in the period following the COVID phase that was characterized by lockdowns. So I think it's important for us to just remember that COVID isn't necessarily over, or the stress caused by COVID isn't over, although lockdowns have ended, and that businesses still require some continuing support to fully recover. Of course, they're being buffeted by some additional structural challenges in the operating environment, including a rising interest rate environment, severe electricity constraints, and in some parts of the country, some natural disasters. So, National Treasury has assessed that some additional and continuing support is required for small businesses as they sort of bounce back or emerge from the phase that was characterized by the most severe lockdowns. To be clear, and as the first speaker outlined, these operating environment challenges, which are the responsibility of government, really need to be addressed, and in some instances are some of the most significant challenges facing SMEs. So policy should really be oriented towards ensuring an enabling operating environment for SMEs. That's the best that we could do as they emerge out of the period characterized by lockdowns. Going forward, now, John, I'm just going to highlight some policy priorities that we hope will help improve the environment for SMEs going forward, and some policy challenges that face us all. The first is an appropriate regulations and streamlining of development finance institutions. So government DFIs have in the past been blighted by mismanagement, and in some instances politically motivated or crony loans, and otherwise governance challenges, but also a culture of poor repayment. So there is general acceptance that some consolidation and redesign is required, which addresses, in particular, challenges relating to repayment. What we've seen through the loan guarantee scheme, as well as in the successor scheme that I'll go into in a second, is that when you work with the private sector, repayment cultures dramatically improve. So this to me indicates an important discussion that we need to have about the role and the nature of public support, public financial support for SMEs. It's not that the quantity necessarily needs to change, but the interface and the interconnection with private sector finance providers who in most instances understand borrowers well and understand the incentives that drive them. Facilitating funding through these sorts of entities may be the most efficient outcome for the public. This reflects the experience of other countries as well. Generally around the world, countries are decreasing the number of state-owned financial institutions precisely because managing these issues has proven very difficult. Even for countries with higher and stronger frameworks of governance more generally. I mean, the most recent example is probably India, where the government is currently on a privatization drive of state banks. This was the case even before coronavirus, where India suffered one of the world's highest bad loan ratios, a persistent obstacle of faster economic growth, and a risk that often cause competing expenditure pressures with other key social spending, such as health, education, etc. So this is a debate and an issue that I think is something that we need to assess and come up with a solution relatively quickly. And I know, for instance, that some discussions around an appropriate redesign, including possible consolidation, is already occurring within government. Next, I'm going to talk about the successor funding mechanism that National Treasury has implemented, and this is really a partial guarantee credit scheme. So as we have moved out, like I said, through the worst phase of the lockdowns, we understand that businesses still need a supportive support mechanisms to access funding, to incentivize particularly survivor businesses to take on investment necessary for their growth. So in some instances, there are businesses that just manage to survive and require further investment. In other cases, there's been some exiting of some businesses in areas, and the survivor businesses would require additional funding to expand their operations and employment. And we think that the bounce back loan scheme, which we introduced earlier in the year, can help provide such support. Unlike the first loan guarantee, under the first scheme, the loan guarantee scheme, there's some key changes that we've introduced to this new scheme. The first being government taking on a 20% first loss as opposed to the first loan guarantee scheme, where we took on we shared losses equally with financial institutions. We believe through engagement with finance providers that this first loss mechanism will result in greater uptake. In addition, and as reflected by the first speaker, we have dropped the requirement of collateral. This is driven by the experience, I guess, of businesses, particularly in KZN following the riots, many of whom have lost or have impaired collateral, and of course, as well as in the more recent KZN floods. We also have expanded the access to the scheme to DFIs that wish to participate, as well as non-bank SME finance providers. But of course, here there is a tension, and I alluded to this tension earlier on. We've capped the loans at repo plus 6.5, which at the moment takes us to around 11, maybe slightly more than that percent. The feedback we've gotten from many non-bank SME providers is that they are unable to raise funding to come in below the capped rate. But of course, we're faced with the tension. We want to provide funding that is cheap enough to incentivize SMEs taking on the loan, including through additional channels. But to expand the number of channels, we have to allow for non-SME providers who source funding at rates much higher than repo to overall drive up the cost of funding to SMEs. So trying to overall manage the overall cost that SMEs will face with expanding channels has been a difficult balancing act. So although we have the scheme already operating through some participating banks, it's just important to mention that unlike the first loan guarantee scheme where all banks were forced to participate, this is on an opt-in basis. So some banks are participating and some banks are not. That we will be periodically reviewing the features of the bounce back scheme to ensure its continued effectiveness. And the first speaker sort of alluded to this, which is the sort of need to improve and to be agile to address on-the-ground changes. So in this way, we'll continue to try and fix the plane while it's in the air. On the policy side, We will also be undertaking some reforms, including facilitating the creation of a SME credit information system. And this is really aimed to address challenges of the credit quality of institutions, as also, I guess, discussed by business partners earlier in this morning's presentations. In addition to this, work is also ongoing on a collateral registry system to allow SMEs to register collateral and reduce their overall cost of funding. So, John, sort of moving to the end here, government is committed to address the structural constraints facing small businesses in order for financial services to become more accessible. To achieve this, the government is currently working on implementing structural or framework reforms as well. These are contained in a financial inclusion, policy document, which has a pillar dedicated to SME access to finance. There is also a South African developed SME access to finance action plan, which proposes specific steps. SMEs operating in the environment will be further supported by National Treasury's broader policy reforms, including supporting financial literacy and consumer financial education through the development of a national consumer financial education strategy, which is high up on the agenda. Work to encourage the use of financial innovation and financial technologies is also ongoing and leveraging the core competencies of a wide range of public sector institutions, including the Reserve Bank, the Financial Sector Conduct Authority, the National Credit Regulator, the Competition Commission, as well as ourselves at National Treasury. The management and market conduct risks are also being addressed through a Conduct of Financial Institutions Bill and the strengthening of an ombuds system, which we hope to take to Parliament in the next couple of months and have that law finalized in the not too distant future. So I'm going to stop there, John, and I think that gives an overall sense of how we assess the overall environment in which SMEs are operating in, the specific measures that we implemented in relation to COVID, but not just COVID, the riots and the floods, as well as give you maybe a slightly elevated view of the overall policy journey and the interventions that we think will be really helpful in reducing the costs, regulatory burden, and be supportive of the overall operating environment for small businesses going forward. Thank you. Let me stop there.
Thank you very much, Vukile. And I think that was a very detailed presentation. Three things from my side. I see colleagues on the chat box sort of crying out for engagement, but we do have a shortage of time. We'll try and create space beyond the webinar to have this conversation continuing. And I'm going to try and sort of lean on you, Vukile, as well, to sort of try and make your remarks available to the audience today. My two questions for you before you go off are, the first one is, the government signed checks to households during COVID from 2020, 2021, and some of these checks are still rolling in the form of the 350 rands grant, and it's continuing until the end of the financial year, until March next year. Why did government not sign checks directly to SMEs? Firstly. Secondly, are we ready for the next crisis? Thank you. Vukile.
Thanks, John. Two challenging questions, which I guess shouldn't surprise which shouldn't surprise me. I mean, you may not remember, John, but back when I was at university, when I at the time thought I wanted to be a journalist. You were the editor of the Sowetan at the time. I did an internship with you at the Sowetan, and I do remember you being equally tough. But addressing these specific questions, why didn't government provide grants to SMEs? So John, I think that in the midst of the crisis, government had to assess the best way to deploy resources and alleviate some of the suffering. There was a wide range of possibilities that were considered, including SME grants. But I think what ultimately I think made it difficult to facilitate these types of grant payments, which we also, by the way, considered in the wake of the KZN riots, is the huge difficulty in verification. So being able to identify a business that has been operating before the riots, that has the information that it's putting forward, that we can verify the information that it's putting forward. We can determine for ourselves that yes, indeed, they're operating in that place, doing that thing. That is a very difficult verification exercise. In addition, as was outlined by Mr. Bierman, a grant would have to be calibrated per sector. So for instance, a 2,000 Rand grant may be appropriate for a small general retailer in a community, but may not be appropriate for a doctor's practice or a small manufacturing operation. So a significant amount of work would have to be done in designing and calibrating an appropriate grant for that to be effective. So I think calibration, as well as a challenge in verification, as well as the fact that there was support being rolled out by line departments, particularly DTI, IC, and Department of Small Business, led us to believe that what we should be focusing on is alleviating the stress on the demand side, on the consumer and the individual side. That's not to say that it's impossible to design such a grant mechanism in the future, but like I say, I think significant amount of work needs to be done in identifying the appropriate beneficiaries of those grants. I know you had a second question. I didn't write it down. Oh, crisis preparedness. So prepared for the next time. I'm glad you brought that up, and I would really I'd really would like us to engage in how we do that. What's clear to me is having some sort of a portal or database of SMEs that we can rely on to effectively deploy support in the event of a crisis is critical. That is difficult, of course, with informal businesses. So what you'll tend to find is that the firms that will continue getting support are the more formal ones, which may not in all instances be the most appropriate response. But having that sense of who the businesses are, what they are doing, and what their needs could be, it has really constrained our ability to deliver effective support in the past, and I imagine will continue being the case unless we really work together to try and address that issue. Let me stop there, John.
Thank you, Vukile, and thank you for outing me. Colleagues, we are steadily edging towards the end of our program of keynote speakers. Before I introduce the next speaker, I should declare an interest that he and I serve on the Wits Business School MBA Advisory Panel. This is but one of numerous contributions he's making to public service in our country. He has worked in senior roles in both the public and private sector environments, especially in the energy industry. In the public sector, he has held strategic positions in economic development and investment promotion, as well as in the development finance space. Mxolisi Matshamba is currently the CEO of SEFA, the Small Enterprise Finance Agency. He's also a non-executive director at Business Partners. Mxolisi, thanks for making the time. Over to you, sir.
Thank you, John, and apologies for connecting late. We were load-shedded here, and our generator took time to kick in. And but it's a pleasure for me to be participating in this forum, and looking forward really for further and future engagements that really will assist us in the whole portfolio of SME development to improve the level of actual growth in the SME sector, which by extension really should contribute to economic growth and job creation. I'm sure most of us have heard, Chair, that government is mainly focusing on driving employment creation, and the core actually to that is the development and the support of SMEs. And I'm glad that my colleague from the Treasury, they share the same sentiments. Chair, from where we sit as SEFA, and we are in the cold phase of SME development, we're seeing actually a trend, particularly from the elderly members of the population, about among South Africans. There's about 60.4% of participants in the recent survey that was conducted by Global Entrepreneurship Monitor SA in 2019-2020. About 60.4% of the participants felt that entrepreneurship is an area that they will pursue as part of their careers, which is a significant improvement from the 49.8% that was recorded in 2017. However, there was a slight decrease when looking at entrepreneurship intentions. South Africans, we recorded about 11.9% compared to about 40% of the other African countries, like in your Egypt, Madagascar, and Morocco, to quote but a few. And furthermore, the rate of business continuance in South Africa is at 4.9%, which is very concerning when compared to about 3.5% established business ownership rate. And from our side, we actually have been working flat out to assist the entrepreneurs, particularly the SMEs that we are funding and those that are not in our books, particularly during the time of COVID. Maybe I should actually state and remind the audience of the role of SEFA, because our role really in this space, our core function is to really foster establishment, development, and growth of SMEs and cooperatives, so as to contribute to poverty alleviation and job creation, including economic growth. We do this by providing access to finance to SMEs and co-ops, and also try to do that in a very, very affordable and efficient manner on a sustainable basis. And we do this, Chair, by delivering this through our wholesale financing division. And we operate in the wholesale financing division through the following modes of delivery, service delivery. One, we provide wholesale finance to intermediaries who actually provide microloans to micro enterprises, predominantly in rural areas. These are the SMEs, Chair, that will give access to finance to those micro enterprises where you find women are involved in their community projects, but they need working capital, they need money to buy equipment, and they will provide loans, for example, as small as 2,000 rands up to 15,000, up to 50,000 rands. And this is an area where, Chair, we've seen a lot of demand, because in the main there, I guess you're dealing with survivalist kind of businesses. We do this work through our intermediaries, and we provide them access to lending for up to 150 million. Secondly, we've got what we call SME wholesale finance, where we provide funding also up to 150 million to intermediaries who extend credit to enterprises who fund, for example, businesses or SMEs that will get contracts in the main from government departments, and also those SMEs who get contracts from corporates. We see a lot of that demand in the mining sector, where SMEs get contract work from the mining houses and other corporates, but they need money and funding really to procure the goods and services that they actually supply to those SMEs, rather to those corporates and government departments. I must declare upfront, our biggest challenge is government's delay in paying the SMEs. And those delays, actually, they result in a lot of what we call inability of these SMEs to service the debt that we provide as SEFA to these SMEs. And if you recall, Chair, or some of us will remember that with IFRS 9, any debt that is older than 120 days, you have to actually impair that debt. It also now, by extension, impacts on the what we call on the book of SEFA because of the behavior of government departments and municipalities with regards to paying the SMEs on time. And it's one area that I know the Treasury and the DTI are working very hard to bridge that gap. But I think more work can be done because that is the main killer of SMEs that we finance through our intermediaries. We also do, Chair, also through intermediaries, and sometimes also we do it through SEFA, the purchase order finance, which also speaks to the same sector. The third one within our wholesale funding space is credit guarantee. We provide, Chair, and it's not linked to the Treasury one. This is a credit guarantee which has been in existence in the country for many years, from the old days of Kula credit guarantee. We extend credit guarantee to banks in the main, and also credit guarantee to corporates. I'll come back to that one. In the banking sector, we provide these credit guarantees for the banks to extend credit to SMEs that would ordinarily not be given access to those loans because of lack of collateral and other various reasons. And then we also do a supplier credit guarantee where we work with corporates. I'll give free airtime to Max Steel, for example. Max Steel provides steel to steel fabricators on credit, and we come in and provide a credit guarantee to Max Steel so that they are able to extend that credit facility to their SMEs. It's one of the best performing interventions actually that we've seen on the ground. With regards to the credit guarantee that we do with the commercial banks, we've seen good performance there, Chair. In the year ended March 2021, last year, we extended 201 million rands of credit guarantee to commercial banks. And in return, the commercial banks extended 1.3 billion rands of credit to the SMEs that we were targeting, which gave us a multiplier effect of 6.5%. To us, that's the best performing credit guarantee because we are working with the banks, what government has been preaching, to extend or actually to crowd in the private sector to support SME development. And these banks are using their own balance sheets actually to extend the credit to SMEs. And in this year, the year ended March 2022, we are looking at a multiplier effect of about 6.38%, which is an improvement from the previous year of this credit guarantee. And I must submit, Chair, the performance has been fantastic if you look at the levels of impairments of our credit guarantees, because we don't give 100% guarantee to the banks. We provide them with up to 80% credit guarantee, and we limit them to about 10 to 15% if the book is not performing. We've got stepping clauses where we say, once you exceed this limit, we're going to have challenges, we need to revisit the credit guarantee. And we're seeing a lot of banks participating. We work with FNB, we work with Standard Bank, we work with ABSA, and now Capitec, after they bought Mercantile Bank, we actually are working with them in that regard. And we're busy actually at an advanced stage engaging Ubank with all the problems that they are facing around liquidity issues. We said we will wait for them to resolve their issues and also see how we revive the relationship, because they were starting to move into the space of SME finance. We work, what I'm trying to say, Chair, with the majority of banks. We're finalizing engagement now with Bidvest Bank also, because what we've seen with the credit guarantee arrangement is that the performance of the book, because we also provide lending through what we call direct lending, where we provide loans of up to 15 million rands directly to SMEs, which is our second product. The biggest challenge that you face, Chair, there with direct lending is the moral dilemma that we deal with, because people, when they see that this is SEFA money, it is therefore government money, and I therefore not have a responsibility to pay back the money. And you see this by looking at the impairment levels of direct lending, and you compare these impairment levels to the credit guarantee scheme, and you also compare these impairments to the SME wholesale funding. The direct lending one has got higher impairments levels than the other ones where we work through intermediaries, which brings back to question that should government be lending directly to the citizens, or should we be doing more of lending through intermediaries and working with the commercial banks and non-financial institutions? Because those ones are performing, they're outperforming direct lending, because they don't have to deal with this moral dilemma of people feeling or behaving in a manner that government money does not have to be paid back. And we are improving those relationships, and we've engaged our colleagues in the Treasury with regards to the new credit guarantee scheme, because we felt we have a critical role to play as SEFA in that space. And we've got the experience and the capacity, because we've walked the journey. And we're pleading with the Treasury that we do need to see what we call a KCG, or cooler credit guarantee, being capitalized. Because the majority of our funding, by the way, is from donors, and being the EU in the main. And we're saying government has to put in some money in that credit guarantee, because it works and the results speak for themselves. We didn't have the problem of the first credit guarantee, where a majority of the money that was guaranteed went to white and predominantly businesses that were ordinarily going to survive in any event. Ours, we don't give a blank check to commercial banks. We give these guarantees with conditionalities, and those conditionalities are linked to the priorities of government, and also our mandate to provide access to finance to predominantly previously disadvantaged SMEs, and also those SMEs that do not have collateral. And to me, banks have been very receptive if you look at the results of the performance of the cooler credit guarantee. We also, Chair, during your what we call the COVID-19 challenges, we actually intervened together with the Department of Small Business, where government set aside about 500 million rands to assist businesses that were hit hard by COVID. And we provided them with working capital, particularly those who did not have money to pay for utilities, your electricity, your rates and taxes, and also your salaries, including rent, because the majority of the SMEs were being evicted by the landlords. And through that intervention, we're able to assist actually a lot of the SMEs. More than 1,000 clients actually applied for that COVID relief program. Coupled with that, when the economy was slightly beginning to open up, we came up with another package of the economic recovery program, which focused in a number of sectors in the economy, and we call that your township and rural entrepreneurship program. And we through that program, we supported a number of enterprises, starting from even your spaza shops your chisanyamas, your auto mechanics, your hair salons, including also your medium-sized enterprises that were struggling to recover. With the one other package that we put together was a program that was targeting now the clients that are in our books, where we're providing them with additional working capital to restart as the economy was opening up. That business recovery program didn't do well because what we picked up, a majority of those clients were already heavily indebted and they were unable to service their debts because of the lockdown of the economy. And then what we did, we said, instead of overgearing these entities, let's rather give them a moratorium on the servicing of the previous loans. And we gave them the first 6 months moratorium on the repayments of the capital and interest on the debt. And because everybody thought this what we call COVID thing will come and go quite soon, but we were all wrong. We then realized after 6 months that the economy was still struggling. And as a result, the SMEs are still struggling. What we did, we gave these SMEs again another 6 months. And these extensions or moratoriums that we're giving to the SMEs, we're doing them after looking at each and every client's challenges so that whatever support we provide, it is custom made to fit the requirements of that particular SMEs. It didn't have a situation where you have what I'll call one size fits all. We've actually now set aside, Chair, about R1 billion now in the Township and Rural Entrepreneurship Program for this current year, where we're providing now loans to SMEs in these sectors that I've mentioned, up to a tune of R1 million. These are your small enterprises, as I mentioned, Chair. These auto mechanics, your chisanyamas in the townships, your spaza shops in the townships, the people who are running your small hair salons and the likes. And we said 10% of that loan of up to 1 million, we make it a grant. That is an effort, Chair, that we're trying to reduce the gearing of these enterprises, because we understand that a majority of them are still struggling to recover from what we call the lockdowns that we've experienced. To give you an example, one of our books that are struggling, or portfolios in the book, is your transport sector, where we were actually providing funding for enterprises that are in the logistics business. For example, the transportation of coal in Mpumalanga predominantly, and the transportation of chrome in your Limpopo and your Northwest provinces, and transportation of what we call in the Northern Cape in the main, transportation of manganese. Because the mines went through that rough patch, the trucking businesses now were grounded. And also when the economy and the mines started opening up, the tonnages, because you found, for example, an SME on the basis, for example, of saying, per month, I will transport 10,000 tons of manganese. And then now the mine shuts down or it scales down, you are transporting 5,000 tons of manganese. Now all your financial projections are gonna be slashed by about 50%. And now what do? You don't want to repossess those trucks, because if you repossess the trucks from those logistics companies, you must now find a way of storing these trucks, provide security. It is safer, therefore, to rather give the entrepreneur a moratorium until at least the tonnage that your financial projections were based on are again recovered, and you are back to that 10,000 tons a month. It's an area where we've seen SMEs struggling a lot. I mean, to give you an example, the portfolio now at risk in the logistics sector in our book is about 62% non-performance. It's reducing as the mines are beginning to open up. It's beginning to drop now, and we expect that it will flatten up over time. So as and when each sector experiences these challenges, we come up, Chair, with these interventions to make sure that the SMEs do not collapse as a result of the challenges that we're facing. We are also looking, Chair, at increasing, as I said earlier on, the credit guarantee budget, so that we are able really to see the impact that we want as we are engaging with these commercial banks. And there's also, we are working now, we're going to be aggressively working with the suppliers in the corporate space, like your Mxolisi and others, to allow them to provide the inputs, the production inputs to the SMEs, and will guarantee actually that credit line as SEFA, because it's one area that we've tested and it seems to work, and it's one of the areas that we're going to be pursuing aggressively. Also, we're looking, Chair, in the space of your township economy in particular, where we've seen, and everybody knows, that the spaza shop market is dominated by people from outside the country, and we picked up some of the practices that we can learn from them. For example, the issue of bulk buying, and also we were in the past providing owners of these spaza shops with credit cards, working with the commercial banks, where a portion of the funding provided was a grant and a portion was a credit facility. And what we realized, people just took the grant portion and walked away. They never came back for the credit line. And now what we're saying, we're going to work directly with suppliers so that they provide the what we call the SMEs or your spaza owners with a direct what we call credit, so that they procure goods on credit, and you don't separate the grant element from the credit line, so that you reduce the cost of what we call of procuring the goods. The intention is that they will actually pass on the reduced costs to their consumers, and also to set up a what we call a SEFA a franchise setup, where we will work with the major producers to buy the stock directly from the manufacturers and supply to the spaza shops. And by so doing, you pass over now those discounts that the franchise will be getting to the operators of these spaza shops. And we're also working closely with the Tiger Brands and the Spark Group, where we're saying, because what we've seen now, Chair, a majority of youth, particularly in the rural areas, they are moving into the space of primary agriculture. We don't know whether it is because of desperation. They've looked for jobs, they couldn't find jobs. And we're saying, let us work with these youth who are moving into the primary agriculture production space, because they have the land. Because if you go to the former homelands in particular, the land is lying fallow there, but they don't have equipment, and they don't have these agricultural extension officers who are supposed to assist them to run the farms efficiently. And thirdly, access to market. So Spark Group came on board and say they're gonna be providing the access to market in those localities, but they need to make sure that these emerging farmers, they produce according to the quality and spec that they want. Then Tiger Brands is already in the space of the aggregator model, where they provide loans to their supplier, the primary agricultural suppliers. And on top of that, they have what we call an aggregator who will manage plus or minus 5 farms and ensure that these farms, they do all the required steps to meet the spec of Tiger and also produce these agricultural products at the time when Tiger needs them. And we're saying that model, Tiger wouldn't work in your areas like your rural Eastern Cape, KZN. They work with average 100 to 200 hectares pieces of land. But if you go to those rural areas, you find that a family owns about 2 hectares, 5 hectares of land, which is too small for their need. And we said, no, we're going to use the aggregator model, because this old-fashioned model of co-ops where you take a bunch of rural women, you put them into this forced marriage, you put money as government. A year later, they are fighting, the whole thing collapses, and you lose all the money. We say, let us use the aggregator model. In fact, in most countries now that we've looked at, the aggregator model is very successful because you have this agronomist who's working with about 3 or 5 farmers. We're saying, don't force these families into an unwanted marriage. You say, a Matshamba family, you got 5 hectares. A Dludlu family, you got 5 hectares. These other family have 5 hectares, bring them together, we work and produce these particular products. And you're gonna be managed by this aggregator. And then the aggregator is gonna provide the agricultural expertise to ensure that we produce on time the required yields that are needed. And then also negotiate the pricing with the other retailers like Spar Group to give these small farmers market access and offtake agreements. So those are some of the interventions that we're going to be putting forward, Chair, in this financial year to assist, in particular, the youth that is desperately looking for employment. And we said if they're moving into this space of primary agriculture, we should be there. In any event, we're already funding your what you call your agro processing as part of our mandate. And we're going to be rolling out these programs. And we've increased actually in the allocation of our budget to those provinces that are actually poorer than your Gauteng, Western Cape, and your KZN Urban. And that is the workman that we'll be engaging, and we'll be working with a multitude of stakeholders. The minister is providing leadership with the finalization of the master plan, and also concluding this social compact where we need to work with the corporates to realize some of these interventions, because as government alone, we're not going to be able to deliver on these issues. Working with the private sector and crowding them in is the best solution, as we're doing with the banking sector and as we're doing with the suppliers to ensure that they use their balance sheet, because for the limited financial resources as government, then work with the private sector to crowd them in to access their balance sheets so that they release these funds to the SMEs and provide market access to all these emerging SMEs. I'll pause there, Chairperson, and unless there's some more that one needs to share. Thank you.
Thank you very much, Mxolisi. I think that was very comprehensive, and I hope you don't mind giving your details, because one of the colleagues on the chat box has been asking about how to assist with settling or financing purchase orders. I think it's a frequently asked questions. So if you can get that, it would be very useful. And I think you've answered quite a lot of questions. We have run a bit over time, but I think it's very important that we engage you so that we don't prejudice you versus the other keynote speakers as well. I have 3 questions for you. And I haven't seen anything sort of directly posed to you. The first one is the question that I've asked of all our keynote speakers today. Are we ready for the next crisis? Secondly, there is, and I think Vukile sort of made reference to the consolidation and the streamlining of the DFIs, development finance institutions. What are we as the ecosystem to expect of this? What are the transitional arrangements? For example, anyone who's doing business with SEFA right now, what should they be expecting as this consolidation exercise is going on? Because I fear that this may just be an exercise to benefit auditors, accountants, lawyers, and prejudice all those in the ecosystem who desperately need help. The last question is, you speak a lot about how you work through intermediaries, such as banks and other service providers. Is this a textbook example of the lack of capacity of the state? Thank you, Police. Over to you.
Thank you, Program Director. Let me start with the last question. Working through intermediaries. It's not really a question of the lack of state. I think it's a deliberate intention to make it easier and much more accessible for SMEs to access a credit. Working with the intermediaries, it assists us to spread our reach. Let me give you, for example, the micro-lending space. Providing microloans, for example, for SEFA, to provide a microloan of 1,000 rands, you can set you back, give or take, about 5,000 rands because of the size of the entity and the processes that you have to go through to process 1,000 rands or 2,500 rands loan. But if you work with a micro lender who is much more lean and agile, you are able to provide loans to more people, even cheaper. The studies that we've done in the micro lending space, they show that government has to subsidize those micro lenders. I'm not talking about the Mxolisis. We're talking about these micro lenders that are driving access to finance for these community-based rural women in the main. A majority of them that are now sustainable out there, they are sustainable because they are subsidized by donor funding from international donors. Otherwise, if they were to operate on their own and the minimum interest rates that they charge, these rural women in particular, they wouldn't be sustainable. So you do need that intermediary setup to us, and but as government, you need to assist them with covering at least the operating costs, because the majority of them, they are NPOs, they are not even for-profit organizations. So the main ones that are two in the country, SEF and Pagamani, I mean, they give us per year, John, more than 80,000 SMEs that are funded, you know, and we deliver actually our development impact through those intermediaries. But the critical issue for the ones that are under your, what you call, microfinance space is to give them that support. We provide them technical support, including systems, and even the interest rate that we charge them is just a cost recovery interest rate for SEFA. We don't make any profit out of them because we knew that space is a development impact space that we need to participate. Then on the space of your commercial banks, you're working there because the banks have got presence almost everywhere in the country, and they've got the balance sheet, by the way, to extend credit, but they are very, very reluctant to extend credit to those enterprises that they view as being high risk, and also without any collateral. And that's where we come in and say, fine, use your balance sheet to extend the credit to these SMEs, and we'll provide the credit guarantee as SEFA. Hence, last year, we were able to provide credit guarantees of about 201 billion, and the banks were happy to 201 million, let me correct myself, 201 million. And the banks in return extended 1.3 billion rands in that year to SMEs. So that is not government money, that 1.3 billion rands is the private sector money. And we've always complaining that the private sector is sitting on money, is not investing, but we're coming with very little interventions to help the private sector to release the money to the real economy. And to us, this intervention that we put in place through the KCG guarantee is working for us, because for every rand that we guarantee, we know that 6.25 rands will be extended to the economy by the commercial banks. So it's not an issue of the capacity of the state, but you are trying to crowd in the private sector to extend services and access to credit for our SMEs. In the space, for example, of supplier credit guarantee, we see that suppliers are reluctant to give credit when these SMEs go and buy inputs for manufacturing. I use the example, Chair, of Max Steel, where the steel fabricators were expected to pay cash upfront when they buy steel from Max Steel. And yet they still have to manufacture this thing and then give their customers 30 days credit. And now the problem is these guys, they don't have those reserves. Then we came in and said, next year, give them credit. Give them on credit these inputs, and then we will guarantee that credit. And the private sector is happy to do that. So we are coming with innovative ways to encourage the private sector to release and extend credit to SMEs. And it works better because remember, it addresses that question of the social dilemma that we face as government. Because if John, I lend you money, let me give you an example. There's an intermediary that we work with. They build the backroom flats in the township, and these people, they will fund the construction and everything of these bedrooms to rent out to those who can't afford to stay in the suburbs. If that person doesn't pay that loan, you can't afford to see SEFA going to attach that forum of Mamukumalo in Soweto because Mamukumalo is not paying for those flats. So it's better for us to work through an intermediary, but we put conditions. We say, as you build those bedroom flats, if there is non-performance, we are not going to attach the forum because we did not build the forum. You build the bedroom flats. And it works because what these guys do, they will build the structures for Mamukumalo at the back of a house, and then they find the tenants themselves. They collect the rent from the tenants themselves. They give a portion to Mamukumalo to just to have some money coming to her. But once that loan of theirs is paid up, they transfer now the responsibility of getting the tenants and also collecting the rent from the tenants to Mamukumalo. So those things, they work better if you're not government. We do need what we call these innovative ways to assist SMEs in the space. Now, the issue of the consolidation of SMEs, you'll be aware that we are in the process of merging SEFA, which is our institution, with SEDA, our sister entity, and the Co-ops Bank that sits with the National Treasury. The work of SEFA will continue because this discussion of the merger has been going on for 2 years plus now. And we've always said to the political leadership, we must not compromise the delivery of service to SMEs because we're busy with the merger. Because SMEs are not interested in the merger. They're interested in accessing credit so that they can run their businesses. So as we're busy working behind the scenes with the merger of the three entities, the work of government and the work of SEFA, the work of SEDA, the work of BCDA must continue. So we are focused actually on delivering on the mandate, but the consolidation will improve the efficiencies of the three entities and also improve the services that we provide to SMEs. For example, the issue of business plans being developed at SEDA, and when this business plan comes to SEFA, it gets disapproved because it doesn't address some of the fundamental issues that will allow SEFA to finance that particular business plan. We say, once we actually have these entities under one roof, we start addressing even the quality of the business plan, the quality of the service providers who actually draft and develop these business plans, the quality of the mentors who are supposed to assist SMEs that need mentoring. And it's one of the issues that these things must be performance-based so that it's not just a question of passing paper. It must actually meet the requirements. So during this transition, I think people must expect an improved service delivery by the three entities. Because one would argue the Co-ops Bank is not as visible as it should be. And we say, under this merged entity, we need to elevate the role of the Co-ops Bank. I'll give an example, Program Director, finally. In our wholesale lending, microfinance, it works well in the rural areas. But when it comes to the township, it doesn't work. And that's also why. And I'll tell you why. My view, there's more honor in the rural areas than you find in our urban areas. The people who chase the credit, our debtors, is that group of women. They will tell you that, listen, we are in this group, we borrowed money, you will pay. And then therefore it tells you that you need a different approach when you go to the township. and we say work through these what we call these stokvels, because there's honor amongst the stokvel members. Why don't we then start working through the stokvels to provide access to credit in the township space? Because that model works there. Group lending works in the rural areas, but not in the township space. So we want to see the chair enclosure, an improvement in providing access to credit with all these interventions. It may take time, but the work of SEFA will not stop because of that, because we're busy as we speak, building capacity. Because one of the things that we realize is that with these like township and rural entrepreneurship program, it is a volumes-driven business, but less values. SEFA was not designed to be a volumes-driven lender. Now, you therefore need to start addressing the issue of capacity to drive those high volumes, but also the role of your intermediaries becomes critical. And we are also capacitating ourselves now in the space. Those who are talking about purchase order finance, we do purchase order finance. I'm taking a proposal to the board in the next 2 weeks where we say, this is the capacity that I need. This is the budget that we're setting aside. And we want to drive that purchase order funding aggressively. Reason being, if you go to the poorer provinces, the main driver of funding is government work, and in the main is purchase order finance. Therefore, we say, let's go there, let's be actually present, let's have the capacity and deliver the impact that we want within that space of SMEs in those poorer provinces. And also look at how do we absorb the challenge of government not paying within 30 days. And we as SEFA, perhaps we can absorb that as long as we are eventually paid. Because what you don't want also, Chair, is a situation where government departments breach session agreements with SEFA, where we have a session that you will pay SEFA, SEFA will pay the SME, and then the SME goes to the government department, changes the bank account of SEFA, corruptly working with some of the department employees, and the money never sees SEFA again. You say now we're going to prioritize government departments that are willing to sign an MOU with a commitment that should you breach the session agreement, you CFO, DG or HOD and head of procurement or supply chain of the department, you will be held liable and you will sue you as SEFA. So those are the drastic measures that we're going to put in place. One province, we lost about 60 million in one government department where monies were redirected to these other SMEs, breaching the session agreement between ourselves and the government department. Those are one of the things that we're just going to be harsh with our colleagues. Thank you, Chair.
Thanks, Mxolisi. Very quickly, are we ready for the next crisis? Are you ready for the next crisis?
Yes, you know what? COVID, bad as it was, it has taught us a whole lot of things. Because we are able now to work with our SMEs without necessarily having to see them face to face. Number one, the COVID has taught us how to improve the use of technology, and it actually helped even some of our SMEs to improve their use of technology. And we're going to be using more and more technology. I think in the next month we'll be launching a new loan origination system that is going to be fully automated, which gives the powers now to the applicant to make sure that they drive the application without having to call anybody at SEFA. Well, that system will tell you, for example, you enter your ID number, it quickly behind the scenes checks whether you're South African. If your ID number is invalid, it tells you don't qualify. Boom, there, it stops there. And also it checks your CIPC registration and working with SARS so that it can automatically check your tax status. All these things that you say, can you email this? Can you scan this? The system now is going to do that work behind the scenes. And it's one of the things that we've learned that, listen, you need to automate to be much more accessible. Because an average South African does have a cell phone. And most of them, they use these cell phones to take pictures of food and post them on Instagram. We're saying use that data now productively for your businesses. And we want to develop apps so that they can also access the application in the through their cell phones and laptops. Also going to roll out portals. There are these municipalities and towns that are too far from SEFA offices, because we can't be joined everywhere. Because if you do that, we're going to start now spending the money that we should be lending to SMEs, paying for the operations of the entity. So let's use technology to ensure that people can access our services efficiently and cheaper for the state. We're busy trying to develop those systems, and we'll be deploying them quite soon. And also, you know, one of the things that we picked up with the events of COVID, the violence and everything, is that you need to be agile. You can't tell a person whose house or business was looted that will take 3 months to come back to you. We need now, we said, let's have this capacity within SEFA where we're going to be responsive to these urgent government programs so that you don't keep people waiting for too long. If you are looted this week, at least the following week, we should be back operating your business. Because if you wait for 3 months, how are you going to pay the salaries and utilities for that period? So from our side, we've learned, and we are putting resources. Because, John, we just recovered. We came out of the, what we call COVID. As they were saying, if let's go back and monitor and work on our core business. Boom, the riots. Now we must intervene quickly. And what it means now, you must take all these people who are running your core business to focus on these interventions. I go to the parliament to report quarterly performance. They're not interested in the delivery of the interventions in KZN. They want to know, how have you done on your annual performance plan, as you promised? Now you need to find a balance, and you need therefore the capacity to deliver on these urgent government interventions, whilst to also continue to deliver on your mandate. So we've learned a lot, and we actually rating ourselves to the use of technology is going to be very critical, and also capacity to drive government programs, because in the main, those programs are high volumes and low value. And as a government entity, we've realized that we can't do away with that. And it's the nature of the game. We just need to ready ourselves. So I can argue that, yes, we'll be ready for the next crisis, but government needs to capacitate the institution so that we're able to deliver that mandate. Thank you, sir.
Thank you very much, Mxolisi, and thank you to all the speakers. Before we close off the session, I thought I should just give you a heads up of our forthcoming research topic. Our research committee of the board has approved our new topic. We need to inquire into the impact and real cost to small businesses of the deepening crisis of municipal dysfunction across the country. You would have seen what the Auditor General is saying about the state of our municipalities. Most of them, bulk of them, are unable to file clean audits for themselves and for their entities. Also, like our other research outputs, this will be an open source and our modest contribution to an environment that is increasingly deteriorating very fast for economic operators. At this point, let me thank everyone, our keynote speakers and their very supportive offices who endured our numerous unreasonable requests, members of the media, participants, and my colleagues, Leandre and Kenan Pade, who made this possible. The event's recording will be available on our website and will be also sent to all the participants at today's webinar. I thank you. Good day. Stay safe.
Thank you, sir. And thank you to colleagues.
Thank you.
Thank you.